2020 was certainly a difficult year on many fronts, and we'll remember it for a lot of different fronts. But for us, we truly enjoyed guiding our clients through what was a very turbulent market year. We look forward to the challenges for 2021 ahead and a lot of analysis that we'll be doing on that front. So today we're going to spend a lot of time looking forward. We're going to go over our predictions for 2021. There's 10 of them. And that'll be presented by our Chief Investment Officer, John Longo, and the Head of Fixed Income, Susan Hayes. Following, we have investment strategist Ermin Sivlak, who's going to comment on the investment landscape that follows the change in presidential administration to President Joe Biden. Before I turn the presentation over to John, just a few logistics. Again, as always, each participant is on listen-only mode. If you have a question during the presentation, there's a chat function located at the bottom of your screen. So we'll be taking questions through the chat function. Today's slides have been sent via email, but John's going to be sharing his screen, so they'll be up on your computer screen for your convenience. And we're also recording today's call that we always post on the Beacon Trust website under the Insight section. That's it for me, so I'll turn the presentation over to John. Thank you.
Thank you, Brian. And thanks everybody for joining us. I'm happy to share our kind of outlook for 2021. I would describe it as moderately optimistic. I think we'd be a little bit more optimistic if the market wasn't up 18% last year. And in the Q&A section, we're happy to kind of address why the market went up so much last year. Of course, we have the standard disclaimer, forward-looking statements, not guaranteed, and you know the rest of the story. Of course, the big picture thing that everyone's focused on, what's going to happen in the stock market. And we're constructive on the stock market, both domestically and internationally. So if we had to put a number on it, we'd say that the market will probably increase in line with long-term historical averages, 8 to 12%, depending upon the index that you're looking at. And I'm going to share with you some of the reasons behind our view. One, as we can see on this screen, the personal savings rate has exploded upwards. Now, you can see from the screen here at the peak of the pandemic, March, April, when we were kind of locked inside our homes, we really weren't spending too much money on anything. So think about what happens in your own ecosystem. You probably didn't take much of a vacation last year. You probably didn't travel as much, whether that's gasoline, Easy Pass. I'm sure you didn't dine as much. You probably didn't get as many haircuts, and I can go on, but that lack of spending, a lot of that, of course, by definition turns into savings, and a lot of that wound up in the stock market. So Econ 101, supply and demand, as supply of funds went into the financial markets, that partially resulted in an increase in the market last year, as well as what we think is going to happen this year. Looking at the graph, you can see historically the savings rate in the US is around 5 to 7%. And as the economy gradually opens, as the vaccines roll out, which will be a theme, we expect the savings rate to go down, but still to be elevated. You can see here it's around 12 to 14%. Drilling down a little bit further on why we're still optimistic on stocks. Yes, if you read the headlines, the stock market is kind of expensive by historical valuation metrics. And PE, price to earnings ratio, is one that the popular press covers. And I'll share with you why that number may not be as bad as it seems. So we've all seen or heard about the FANG stocks, Facebook, Amazon, Netflix, Google. And yes, those huge mega cap stocks that have been leading the market are kind of expensive. You can see here that if I look at the PE of those 10 stocks, including Tesla, which has a very elevated PE, that number is 30. But if I back that out and look at the remaining 490 stocks, it's 19.7. A little bit elevated, but I can argue that with exceptionally low interest rates, we should deserve a higher PE multiple. So bottom line, the market is not as expensive as it appears if you look beneath the surface and at the median stock. Not only that, earnings are expected to increase substantially. This will be one of our forecasts as well about what's going to happen to S&P earnings. What you can see here is that the blue part are forecasted earnings. And I know we're in early 2021, but the earnings are just starting to be reported. you can see the sharp drop in earnings because of the recession, not only the profits recession, but actual economic recession. As the economy gradually opens up, we expect earnings to increase. And then really next year, when the vaccine's out in full force, we expect to see a more sizable increase. So if you could look ahead really 2 years, the market, I would say, is reasonably valued. We're optimistic on US stocks, but also global stocks as well. And I know there's a lot going on in this picture, but let me break it down for you. The blue diamond is where we are now, right? So we have several markets, the US, developed markets, Europe, Japan, emerging markets. So here's the blue diamond, and the US is on the expensive side. But if you look at emerging markets, they're much, much more reasonable, perhaps 25% cheaper on a valuation perspective, and there's higher growth. The purple band is the 25-year average. So around the world, stocks are more expensive than usual. But as I mentioned, I think the extremely low level of interest rates around the world are one of the reasons that justify it. And if you're curious about the rest of the graph, the bands are kind of like plus and minus 2 standard deviations, or you can view it as the historical reasonable ranges. All right, that's our first forecast, bullish on equities, both domestically and internationally. The second one really ties to the economy, that we know that the vaccine rollout has been kind of slow. We do believe that's going to pick up. In addition, we shortly expect, within really a week or two, Johnson & Johnson to get their vaccine approved, in addition to what's happening with Pfizer and Moderna. One advantage of the J&J vaccine is that you only need 1 shot as opposed to 2 with the other aforementioned vaccines. So how you can kind of interpret this graph, and by the way, if you're curious about following this, you can just kind of search or Google Bloomberg Vaccine Tracker. And the states that are in bright green are probably doing a better job getting a higher proportion of their population vaccinated. And I know we have clients from all around the country. Many of us are here in New York and New Jersey. They're on the lower side, although our friends in Florida are doing pretty well. In terms of what the vaccine rollout might look like, here's a screen capture from the state of Massachusetts. And I think most states are similar. They get guidelines from the CDC. So clearly phase 1, which is still ongoing in most areas, are the healthcare workers. They're first and foremost. Then we have police, fire, and emergency. They're obviously crucial just to the functioning of our society. And as we look in phase 2, it might be the elderly, people with 2 or more serious conditions, teachers, people working in the grocery store, workers that we would kind of deem essential, as well as older adults that are at risk. And then in terms of the rest of the public, let's say younger people that are healthy, probably April till June. And then, as you know, it takes a little while for the vaccine to be fully disseminated, as well as, to get immunity. So our initial thoughts when we were doing this late last year is by the summer, we would be back to close to normal. Now I'm thinking probably early fall, September or October or so. Our third forecast, I would say, is probably our easiest, and I'll kind of share why. And we have 2 pictures here. One is the S&P 500 in blue, which, as of a couple of days ago is an all-time high. It's back up pretty strongly today. And then we have earnings over here in kind of this orangish picture on the right, and you can see the earnings go off the cliff. Now, some of these earnings are cash, some are not cash. So for example, if you follow the markets closely, Boeing came out with their earnings and they had a $12 billion loss. That is counted in this number. Now, some of the loss is cash, some, in many cases, it's non-cash. And the bottom line is that these massive drops in earnings are likely to be gradually reversed in 2021 and really 2022. And I think that, will be positive for equities. Expanding upon that, let's look at some of the sectors or industries that have been hardest hit. So at the peak of the pandemic, seated dining was prohibited. So every restaurant was literally shut, at least for, you can do takeout, but seated dining. Traveling was only permitted for essential workers, let's say healthcare workers traveling across the country. Another thing to look at is we all use Google Maps and things of that nature. That was down 82%. As I mentioned before, you probably didn't take a vacation last summer. That was down 70%. And you can see other things as well. But what's interesting now is where we are now. This gives us a clue for how close we are to opening the economy. And you can see clearly it's not good news yet for the airline industry, for the restaurant industry. Hotels are gradually recovering, but the consumer is spending. I know my family's buying a lot more on Amazon and Walmart and things like that, and I'm sure your family is. So this is kind of a clue of maybe what's happening with GDP before some of the stimulus. But there's always some offsetting things. The drop in interest rates was excellent for refinancing your mortgage. So hopefully you did that if you had an opportunity. Moving on to our fourth forecast, we think economic growth is going to gradually accelerate as the economy gradually opens up through the vaccinations. So what we can see here is we had a pretty strong rebound in Q3 after the dismal Q2. And if you read some of the financial news today, 2020 full year GDP was down 3.5%. Doesn't sound like a big number, but it was deeper than the Great Recession. And it was actually the largest number on record since 1946. So looking ahead towards Q1, that number is expected to be about 2%. It was actually expected to be lower if we didn't get the stimulus packages that are kind of en route. Those numbers are expected to go from 2% to 4 or 5 as we go throughout the year. So we don't want to get too bearish if the economy is expanding, and we think it's likely to increase. So if you're curious, the solid part is the average estimate, while the dots are the forecasts of various economists in the journal's forecasting survey. Moving on to forecast 5, we think volatility is going to decrease. It certainly decreased today after yesterday's uptick. And I have two charts here. Let's look at the 5-year chart first on the right. So one measure of volatility is VIX. You can view it as what people are willing to pay for insurance using options. And over the past 5 years or so, that number is average around 15 or so. During the peak of the pandemic, we see on the left-hand side, it peaked at around 66 intraday. It actually hit an incredible 80, and it's still at elevated levels. So we've had a number of risk issues gradually go in the rearview mirror. Ermin's going to talk in detail about the political landscape. We had a very contentious election that is now behind us. We have the vaccinations, the Operation Warp Speed that are now getting out. And I think people still are scarred a little bit from this whole pandemic. I mean, clearly it's been a very serious healthcare crisis. But as we have a return to normalcy, which is one of our themes, we also expect volatility to fall from the 27 level it is today, or 23 when we did the presentation, to let's call it 15 to maybe 20. And that's usually good for risk assets as well. Moving on to forecast 6. As I said, we're kind of constructive on the markets, and what we think is going to lead the market this year are those industries that have been beaten up last year. So this is an internet bubble part 2, where companies like AOL and JDSU and others had no earnings that crashed. Clearly the FANG stocks, Facebook, Amazon, Netflix, Google, these are exceptionally strong companies. They have strong earnings. They're going to be around 50 plus years. But we think that in terms of who's going to lead, it's those beaten up industries, airlines, hotels, energy, which is a proxy for the economy, and even banking and utilities. Moving on to forecast 7, I know real estate is important to many of our clients. And if you follow the real estate indexes, one is called Case-Shiller. That came out with an incredible 9% year-over-year increase last month. There's a little bit of a lag, so the November date is the most recent we had. This is an extremely high number. Over the past 5 years, that number has been about 5%, but obviously we recovered from the Great Recession of 2008, 2009. If I go out 20, 30 years, the pace is around 3%. So we think real estate is still a reasonable place to be, but we expect the pace to be at the low to mid single digits. Now I'm going to share with you our 8th forecast, and then I'm going to hand it to my colleague Susan. Unemployment is of concern for people watching the macro economy. And you can see here, we were going along at 3.5%. Then we had the peak of the pandemic at 14.8%, which is depression-like levels. And these numbers have gradually been coming down. We think, though, it is unlikely that we're going to get back at 3.5% levels. Number one, some firms have been fatally wounded. I'm sure you're aware of a number of firms that have been bankrupt. And two, I think companies will be a little bit cautious. Three, we found ways to do things with technology. We're doing this conference via Zoom, and there might be less real estate in terms of at least the corporate side. So we think it's unlikely we're going to get back to this 3.5 number, at least anytime soon, certainly within 2021. So with that, I'm going to hand it to my colleague Susan, our head of fixed income, who's going to share with you some of our Fed and fixed income oriented forecasts.
Thanks, John, and thanks everybody for being with us today. I'm going to cover some information on the Federal Reserve and monetary policy, also interest rates and inflation, and then end with our outlook for 2021. So the year 2020 last year, it can't be overstated enough how much the Federal Reserve was instrumental in calming markets, especially in March and April where markets were frozen up. To get the economy back on a path where hopefully in the second half of this year, we are going to be on a path to recovery in later 2021. The two main tools that the Federal Reserve has to try to help the economy is rate setting ability, which this slide shows the Fed funds rate, and also their balance sheet, purchasing bonds out in the market to try to tamp down interest rates, to help people borrow from banks, help things like people, buy new cars, auto loans, housing, things like that. So you can see the Fed funds rate in January of 19 was up around 2.5%. It had been there for, a few months. Then all of a sudden in March, the beginning of March, when the crisis hit, the pandemic hit, they quickly dropped rates to zero, and they've been there ever since. And this is really one of the main ways the Fed has to try to spur on the economy. Yesterday at the Federal Reserve meeting, Chair Powell reiterated what he's been saying for many, many months, is that the Federal Reserve has no desire to raise interest rates until the economy is back in a place where they're at full employment and they have price stability, meaning inflation. So, rates are low for now. We foresee them being probably at this zero, end of the range until 2023 or longer. The Fed will remain very, very accommodative and not prematurely raise interest rates. I know that's something that's been in the media a lot lately. People harken back to the taper tantrum with Ben Bernanke, where they hinted at the fact that they were going to start to, not buy as many bonds, and the market reacted in a very, very bad fashion. I think the Federal Reserve now is telegraphing the messages sooner and much more clearly, and they clearly said yesterday that they won't raise interest rates prematurely. So John, next slide, thank you. So the next slide, our second part of forecast number 9, illustrates a widely watched measure of inflation, which is the Consumer Price Index. That's a measure of average price change for market baskets of goods and services in the economy. So the Fed stated goal of inflation is 2%. It's been that for quite a long time, but they've not been able to reach that goal and sustain it for over a quarter of a century. So you can see, looking on the left-hand side of the chart, in January of 2020, and for the first part of 2020, it was a little bit above 2%, but then obviously with the pandemic, inflation rates went very, very low. If you extrapolate out, like I said, 25 years, the Fed has struggled to get inflation to 2%. So in August of this year, they introduced a framework that they said that they were wanted to average out 2% inflation over time, and that now they're willing to, in periods where the economy is doing much better, let inflation run a little bit hotter, meaning run above 2%, to compensate for periods of time where inflation is running too low. They're not putting any kind of target on it, any kind of time or end date, but they're saying they're going to average 2% over time. And I think that's key, over time. We don't know how many months or years, but I think the Federal Reserve realized that they were not able to hit their 2% goal, and now that they are, coming up with a new framework to try to hopefully sustain that 2%. I mean, ultimately, they need to see both employment and inflation back to the stated goals. We still have 9 million people out of work, and inflation, obviously, as I said, is below that 2%. So until they hit those or are closer to hitting those two goals, I don't think they're going to make any major changes, and they're going to continue to be supportive of the economy and very accommodative. Next slide. So this is a chart of the benchmark 10-year Treasury yield. This is something that I look at all day, every day, being in the bond market. And if I extrapolated it out on the left-hand side, we began 2020 at around a 1.91% yield. And then you can see rates in the summertime, in the middle of July and August, went down to around 50 basis points. Rates have been rising recently. Most of the move came after the election and Joe Biden was elected president. With that comes the thought that there will be more stimulus. Obviously, right now, he's talking about a $1.9 trillion plan. We just passed $900 billion of stimulus in December. That potentially could have an inflationary effect, which leads to the so-called reflation trade, which raises interest rates. Now, you can see in December and January, interest rates went up from around 90 basis points to a little bit over 1%. We're perfectly comfortable with that. I'd like to see interest rates be above 1% and sustain that. We think they could go a little bit higher. Our target range for 10-year treasuries this year is 75 basis points to 1.5. We do think on the back end of the year, when vaccines are widely distributed, when people are out in the economy, traveling again and using the services that have really sort of been on hold, that you could see interest rates migrate up towards potentially 1.5% in the second half of the year. Now, the effect on fixed income portfolios is probably going to have sort of muted returns this year. So last year was a very good year in fixed income. We expect this year to produce coupon-like returns because you do have increasing interest rates, which could potentially dampen the price part of the total return component. But again, probably a more muted year in total return terms than we had in 2020 for sure. And with that, I'd like to turn it over to my colleague, Ermin Sivilek, that's going to discuss the post-election landscape.
Thanks, Susan. I'd like to start by talking about the current political landscape and then discuss some of the investment implications under the new administration. After Democrats won both of the Georgia runoff elections 3 weeks ago, we now have a 50-50 balance in the Senate, with only the newly elected vice president breaking a tie if necessary. And that's, by definition, the tiniest margin possible. The Georgia runoffs also had razor-thin margins. Only 55,000 votes separated Jon Ossoff, the Democratic candidate, from David Perdue, the Republican incumbent. Said another way, in a country of 330 million people, it came down to just 55,000 votes, which is 0.016% of the population, to determine whether we would have a unified government, a blue sweep, with the same party controlling both chambers of the Congress, as well as the executive branch, or a divided government with two parties in charge. But as we've said in the past many times, it really doesn't matter all that much when it comes to how financial markets perform under various combinations of Democrats and Republicans controlling different parts of the federal government. In fact, every Democratic president since 1921, when Woodrow Wilson was the president, started their term with the full support of the House and the Senate being in Democratic hands. And the stock market did just fine, up 11% on average over the following 12-month period. We've actually seen a very strong rally since the election day last November. Market is up 15% since then, the S&P 500 index, that is. But those facts alone, of course, don't necessarily mean that we're expecting the sky to be the limit for stocks over the next year. In fact, we do expect a correction at some point, but we're fairly optimistic, as John pointed out, that there will be strong economic growth. Corporate earnings will be robust this year, and the unemployment rate will continue to trend downwards, which should and could lead to higher consumer spending, not lower. But the Democratic leadership will ultimately set the agenda and decide which legislation is brought to the floor of the House and the Senate for a vote. But with such tight margins in both chambers of the Congress, centrist politicians such as Joe Manchin and Kyrsten Sinema on the left and Susan Collins and Mitt Romney on the right will have great influence on which legislation ultimately gets passed. We do think there will be additional fiscal stimulus. The price tag will be up for a debate, whether it's 1 trillion, 1.5, 2 trillion, but we do expect significant aid going to families, businesses, states, and local governments. Sometime over the next few months, there will also be a large infrastructure bill introduced to not only fix our aging roads and bridges, but also further develop the next wave of wireless towers and fiber networks. Engineering companies, construction companies, and industrial sectors should benefit from such spending. Another sector that we expect to do well is the financial sector, which didn't really participate in the rally last year because of loan losses or expected loan losses and low interest rates. But with higher GDP growth, which would push the interest rates higher and steepen the yield curve, that should boost the interest rate margins for the banks. Clean energy sector is something we're all reading about since the election. It's getting a big boost after Biden's win, and it should continue to thrive with increased spending on renewables such as solar and wind and hydroelectric power. Also, electric cars and various battery technologies should do well in a push to reduce the carbon emission volume. And we look at these areas opportunistically, but we're mindful of the fact that a lot of these emerging technologies come with much higher volatility than blue chip stocks. So we're mindful of that. And in contrast to the clean energy sector, the traditional energy sector, oil and gas, can come under pressure if there's a very strong push away from fossil fuels. But the energy sector, the traditional energy sector, tends to be a smaller part of the investment universe compared to sectors like financials and technology. It makes up less than 3% of the S&P 500 index. Another area that may come under pressure is the technology sector, especially if corporate tax rates go higher and there is tougher regulation of the big tech. Tech companies currently pay the lowest effective tax rates. They sometimes take advantage of loopholes over the globe, and they will be much more sensitive to a change in the tax rates. They also have higher sensitivity to change in interest rates because interest rate spikes would effectively reduce the multiple of earnings investors are willing to pay when they buy company stock. That being said, if the tech sector continues to deliver growth as it has been throughout the pandemic, investors will get rewarded by higher stock prices. After all, we do believe that these long-term catalysts will continue to favor the tech sector, especially the disruptive, the innovative growth companies. In terms of the small cap sector, with additional federal aid going to small businesses, we think that small cap stocks will take the leadership from large cap stocks, which have done well during the pandemic due to their larger resources. And typically when US economy reemerges from recessions, we were in a recession last year, small cap companies do well. They outperform large caps, and we do expect that to repeat. And they're also less sensitive to trade tensions if they reemerge with our trading partners. On the international front, the dollar could be a tailwind for overseas companies. With all the deficit spending to fund various fiscal programs, the dollar can continue to depreciate, which makes international stocks more appealing, especially those that grow their revenues and earnings and cash flows at above average rates and those that trade at cheaper valuations. In terms of the overall tax environment, we do expect some changes, but we don't expect dramatic restructuring of the tax code. We can talk until midnight about various tax proposals, but But our thoughts in summary is that there's a possibility of moving the top individual tax bracket from 37% back to 39.6%, which is where it was 3 years ago, as well as increasing the corporate income tax rates, which are now at 21%. They were at 35%. So they can move up a few percentage points. It's not going to hurt. It's not going to kill the stock market. The capital gain tax rates may move up a little bit for high income tax brackets, but an across the board tax increase or proposals like taxing capital gains at ordinary tax rates, it's really not likely. It would only take one moderate Democrat to vote against such legislation to defeat the legislation. We may actually see a tax cut in the form of higher state and local income tax deduction or SALT deduction on federal tax returns, especially if AMT or the alternative minimum tax rules don't change to offset such higher deduction. That would obviously benefit residents of high tax states such as New York and New Jersey. Now, on the social front, there's obviously a lot of programs that are going to be discussed, and some will be implemented, such as rental assistance, further loan forgiveness for students, ban on evictions, and even free community college. Those could become reality. We already saw some executive action taking place over the past week since Biden took over. That being said, investors have been fearful of these radical progressive ideas such as Medicare for All, Green New Deal, which would cost trillions of dollars. And I think they face slim prospects due to the filibuster rules in the Senate. And the highest priority clearly will be tackling COVID, the vaccine rollout, and focusing on the economy. But interest in ESG investing or socially responsible investing will definitely pick up in terms of the interest in ESG investing. So what does this all mean for the stock market? All things being considered, I think the next 2 years until the midterm elections may be net positive for the stock market, perhaps not advancing at the same strong pace of 2020, but any negative impact of marginally higher taxes or increased regulation should be more than offset by the positive effects of strong fiscal stimulus, which will be in trillions of dollars, as well as the extremely accommodating monetary policy implemented by the Fed. But we're still in the middle of a public health crisis, and market volatility over the long term will come down from these elevated levels. But over the short term, we do expect some choppiness until we get a little bit more visibility on the legislative side and on the healthcare front. Market sell-off is likely this year, just like we experience almost every single year. But we view these sell-offs as really healthy resets of investor mindset to work off any froth in the market and to really set the stage for the next leg of the market. Ultimately, it comes down to really having a good investment plan in place, staying disciplined, and perhaps most importantly, avoiding making emotionally driven investment decisions. Those are really the recipes to success. So with that, I'll stop here and turn it over to Brian for any closing comments or to see if we have any questions.
Thanks, Urban, and thanks, John, and thanks, Susan, for the comments. In wrapping up, I hope you get the sense that we are optimistic and looking forward to 2021 for sure. We all see the light at the end of the tunnel with the vaccine rollout and the prospects for more companies in the development stage for vaccines, Johnson & Johnson being the one that's most pressing to us here. We do have a question that we did get via chat here regarding inflation. So I'm going to turn this over to both Susan and John. The risk of higher inflation due to large fiscal stimulus. And the number we don't know yet, the proposal is for 1.9 trillion, out there right now. It could be negotiated downwards or upwards. We can see, but can you comment on the prospect of higher inflation, both on equities and fixed income?
Sure. John, do you want me to go first?
Go ahead, Susan.
Sure. Right. I know inflation has been back in the news a lot lately. You know, I touched on it a little bit before. I mean, the Fed Chair Powell was actually asked about it yesterday in the press conference, and we think that there's potential for some inflation coming on the back end of the year, but we don't think it's going to be runaway inflation like you saw in the 80s. We think that there's a healthy kind of inflation. I mean, you've had basically big parts of the economy shut down with no pricing power, no one using their services. So we think that, you know, if those parts start to come back and there is some pricing power there, that is actually beneficial. You know, Chair Powell yesterday actually said that deflation is much more of a threat to the economy than inflation. If inflation runs higher, you know, they won't put a number on it. If it runs 2.5% for several months, they've said that they're okay with that. And I think that the economy can handle an environment where inflation is a little bit above from where, you know, where we've been. Obviously, the chart that I showed in the past year or so, we've been sort of around that 1.5%. You know, the Federal Reserve knows what to do when there's too much inflation. On the flip side, it's more problematic for them to try to get inflation going when they're in a deflationary spiral. So I think that there is potential for inflation. We haven't had it for a long time. Again, as Brian said, it really depends on the amount of stimulus. I think that right now it seems as if there is going to be pushback from moderate Democrats on the 1.9 trillion. It's a big number for sure. You know, Janet Yellen, the new Secretary of Treasury, has said we need to go big. Don't worry about the federal debt right now. Just get the money into the marketplace. But I don't know how much of an appetite there is just to push through huge packages after they've already had the CARES Act, after they had the $900 billion in December. So it remains to be seen. I think there's a potential for inflation to pick up, but we don't think it's going to be rampant runaway, you know, 3-4% inflation that's sustained over time. John, do you have
Let me
thoughts
just
on
add
that?
to that. So, you know, I echo your comments that I expect an uptick in inflation, but not kind of runaway inflation. We've seen commodities, for example, at multi-year highs. Gold is doing pretty well year over year. But even though the Fed's balance sheet is now at $7 trillion, one indicator I look at is the velocity of money, and that has collapsed. So you got to put the two together to see how that's going to impact inflation. So overall, a little bit inflation's there. How we would navigate that are assets that do well in an inflationary environment. They tend to include equities, especially those that can have pricing power, as well as real estate, and we do have some commodities indirectly.
Yeah, I think some of those alternative asset classes that that we have exposure to in some of the portfolios also help. Real assets, some private equity, things of that nature, protect portfolios against a rampant inflation. But again, just to highlight, our expectation is that inflation does not run away out of control, even with the tremendous amount of stimulus and the size of the Fed's balance sheet for the time being. I think the economy can take a little bit of good inflation, you know, in its recovery phase here. Next question, I'm going to direct more toward Ermin, and I know that you know we had the themes out there that small cap, international. We always recommend diversified portfolios, not only from an asset class standpoint, but from a market cap standpoint, geography standpoint. So how do we participate in asset class and the success there? And I'll leave that with Ermin.
Yeah, we really have an open architecture portfolio of investment strategies. We do have one specific strategy offered by our Tirschwell Lowy offering that will allow investors to participate in these smaller, faster growing companies. In combination with that, we have exchange traded funds and actively traded mutual funds to participate in those areas that we expect perhaps faster growth and you know, starting from lower valuations. When it comes to international equity investing, that's an area we typically go very active because cross-stock correlations tend to be high. Inefficiencies seem to be high when it comes to investing overseas. So we partner with third-party managers to supplement our in-house offerings when it comes to international equity investing.
Thanks, Herman. The question on China. China is the only economy that proved to have positive growth, the only major economy that proved to have positive growth in the year 2020. Seems to be chugging right along as well with a reopened economy. But politically, the challenge comes about, again, with the change in administration, but also internally. Anyone want to comment on China?
I could start. As some of you know, I typically spend 1 or 2 weeks a year in China, not this year with the pandemic. So I do have a fair amount of contacts there. And it's a very complicated situation. So China is clearly the largest economy for many goods, the automobile market, luxury goods, commodities. So we don't want to just completely exit those markets. What President Biden has said is that he's looking to look at a more collaborative approach, especially with our allies in Europe and the rest of Asia, and hopefully encourage fair and open markets. That's kind of the best scenario. If China is not receptive to that approach, we could continue to see tariff wars and other things, which I think could roil the markets a little bit. So I think we all have an incentive to work together ultimately. And I think we can get there, but I think it's going to be kind of rocky road. One last point, and then I'll hand it to my colleagues. China is developing a lot of intellectual property. You're probably familiar with companies like TikTok and doing quite well in AI. So as they generate more of that IP, I think they are going to respect open markets and not theft of intellectual property. And that is a long-term positive as well. So I don't know if anyone wants to add anything to that.
The only thing that I would add is that, again, some of the, new administration's policies will be taking, a very close look at over the first, obviously the first 100 days of the administration. We've seen lots of executive orders on lots of different subject matter and topics and so forth. And the global trade relationship is something that we'll keep a close eye on and on its effects on the markets. I don't see any other questions coming through the chat, so we're bumping up on 45 minutes here. So I want to be respectful of everyone out there's times. The only thing that I'd like to, again, circle back in is a very big thank you to our clients who, kept up with us last year. We tried to do a lot more communicating last year on the corporate level and just make sure that our thoughts on the markets and on developments were very clear. Hopefully you've gotten a glimpse of what we expect in 2021 from this webinar. We are, thankful and again, we are looking at that light at the end of the tunnel. We want to get back out and have much more human interaction. We appreciate the Zoom technology and to be able to get out and have virtual face-to-face meetings with clients, but we certainly missed, one of the big things that we missed last year was the human interaction. So if we could speed it up or have any influence on speeding it up, we would do it. We don't, so we're going to exert patience here, but we're really looking forward to the day where we can get back together at certain Beacon events or traveling around to visit one-on-one. So again, thank you for your time. We're going to wrap it up here. Certainly enjoyed it. Hope you did too. And look for any feedback. Thank you.